It is now unbelievably the 2nd of March 2025. And the markets, if you look at them, of what's been happening in Bitcoin and crypto over the last week or so, since last Monday when I had that nice little move to the downside, preceded by the obvious VEPS information telling you it was very likely going to dump, and it did. And then since then, it was basically saying it was very likely going to walk back up a little bit, and it has. And across pretty much all the markets, all the cryptos that were in that particular schwung, you could see that that is exactly what happened. And do you know why that is? It's the Bitcoin signal that never misses. That's right. It's the VEPS information. What is VEPS? Well, if you don't know, it's volatility, entropy, probabilities, and statistics, right? Which I know if you are a follower of all the regular YouTube Jimmies, you probably have no idea what that is, because they will never tell you about that. Because A, they either don't know about it, most of them don't. B, even if they have some idea about it, because they've heard about it from someone, they don't really know. What they think they know is wrong. And some of them kind of use increasingly what they think are volatility indicators and probability indicators, but they're not. And usually that's because they don't have good math. How do we know they don't have good math? Well, because our guys at Alpha Trading, who built our math indicators, our math-based indicators, they know math really, 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 really well. Better than most. And if not, they're in the top league. Our top math brain is a top math brain. And our indicator maker, he's really damn good, our top indicator maker. And together, our top guys make really great indicators. What can I tell you? They figured out some of the things that are not right on the platforms that people use to make their indicators. Without getting too deep into it, I'll just tell you, the indicators people think they're using, that they think are indicating them something, they're not. When you put them side by side with ours, you can see very clearly they have a flaw, and we know exactly what that flaw is. And I can just tell you, it's in the math, right? It's in the way the indicators are built and the math they use. So, anyway, now, but of course, most importantly, again, 99.99% of those YouTube Jimmies, they don't even know about the volatility at all. They might use the word, oh, it's volatile. They don't actually know what that means. And I'm sure you've seen thumbnails and videos, if you're in the crypto space, which start like very, today in the Bitcoin price market or whatever, and then they'll give you, this signal has never missed, right? And then they'll show you something that's like some silly pattern that's never missed until it does. And then it invalidates that signal, but they'll keep flogging it for years to come. I'm sure you've seen a bunch of these, because there's always some silly quote-unquote signal that they will tell you never missed. Well, okay, you can pull endless amounts of data and come up with information and create signals that have never missed very easily. It's not hard. It also is really useless when it comes to trading low time frames. And when these people are encouraging you to trade with leverage, leverage is not a thing you should be using on high time frames. It's extreme, especially not high leverage, which most people in crypto seem to tend to do. If you look at the average leverage position, it's not 1.5x or 2x or even 3x. It's like 5x is like on the low side, right? People are at the least using 10x in most cases. Yeah, sometimes they try to be smart and sneaky and they use like 7x, right? 6.9x because of the meme, right? But most of them are using 20, 30, 40, 50x. And I know that sounds crazy, but that is actually very common in the crypto space, right? People are using insanely high leverage. And you ask yourself, well, why are they doing that? Well, they're doing that because they're trying to make a big high time frame trade using leverage that's intended for, well, getting wrecked. It's really that kind of leverage, anything over really 3x. You know, if you're not in and out of that trade in like a minute or two or 10 at the most, you know, if the trade happens to be going your way, 10 minutes is very unlikely, you're making a big mistake, right? You're very likely going to get wrecked. But why? If I get in the trade and it goes up and I'm in a long, why should I be worried about that? Well, you know, at the end of the day, right, returns distribute away from the means and returns mean revert to the means, right? So that's why, because the price action follows the returns, right? And what creates those returns? Well, it's the standard deviation of returns that creates the returns. It's not the returns that create the standard deviation of returns, by the way. It's the standard deviation of returns that creates the returns, right? But how can that be? Well, because it's literally the spread of the data around the mean of returns that create the current returns, right? So, and that spread is the standard deviation of the returns. And when you look at the spread of data around the mean and the correlation to the data set, then you get the direction. The tendency is that we'll show you the direction. When you know that direction, you see the direction it goes, and lo and behold, that standard deviation of returns with that correlation, that volatility, and that correlation creates the returns, right? And then the returns and its correlation also show you the direction. And guess what? Price action just follows what that's doing. So it's like a little chain of events, right? On the one side, you got volatility with correlation leading your returns and its correlation, leading the price action. On the other side, you can do the same exact thing with entropy and its correlation, leading the price action. Both of them work hand in hand. The volatility and correlation and the entropy and correlation, they both work hand in hand at primary levels of leading information, right? It's not like one is better than the other. No, they both work. VEPS is a complete system, right, that works together in harmony like an orchestra, right? All the pieces move together in sync like an orchestra, like a well-conducted and well-managed and well-organized and well-practiced orchestra. All those well things. Like a well-managed well. An endless source of liquidity. Which is what the market is, basically, right? The market is just liquidity. It's people putting money onto trades and hoping to take out more than they put in. But most people don't take out more than they put in because of greed and foolishness. So they'll get into a trade, it'll go the wrong way against them, and they'll stay in it instead of just getting out. hoping that it'll go back to zero. Well, that's foolish. Better just rip the Band-Aid off. Hey, buddy. And on the other side, they get in a trade and it goes profitable. They don't just get out and take their profit. They stay in the trades. So does it matter, for example, in the case of Bitcoin, if Bitcoin dumps to 70K right now and you're trading, does it matter? And you're in a long, right? Does it matter if you enter a long and suddenly it starts dumping? Should you just stay in the trade and wait for it to go back up? Or should you just get out of the trade, right, and reposition when you have the next occurrence of opportunity? And of course, that's the answer, is you should get out of the trade. Limit your loss. Okay? Why should you suffer whatever percentage that would be of a loss, which may be temporary, but it may not be? Why would you want to bet on, a losing position? Why not just get out of the trade? So what if you lost a few bucks? Just you lose a few bucks. It's better than being underwater thousands of dollars and potentially getting wrecked. So anyway, that's your Bitcoin signal that never misses, right? It's the VEPS, folks. It's the VEPS. Learn to read it. It's free. You can learn to read the VEPS for free. Just come to our Discord and get those free tools, free indicators, free whatever. All you got to do is just go to alphatraడింghq.com/Discord, and you can get our free indicators there. When you enter the Discord, there's a message there. It's got all the info you need to know right there. It tells you how to get the indies. Do what it says, and enjoy your trading. It shouldn't be an ordeal. If it is an ordeal, then you probably shouldn't be doing it. And I say that because really, statistically, most people should not be trading. Most people are not traders and should not be trading. It's just a fact, right? And really, most people are not traders, and they don't trade, right? And that's actually fine. And also, most people aren't even investors, right? But that's a separate story. But trading-wise, really, you think about it, most human beings should not trade at all, for the very simple reason, right, that it's not something most people can handle. It's just not, right? But if you are one of the people that actually can, then you want to make sure you're doing it correctly. And the way you do that is to make sure you're using the right tools and you have the right information and you know how to read it correctly and how to take correct actions, based on the information you have. And the fact is that the lagging information of traditional TA will never give you an edge because it's lagging information. By definition, it's telling you stuff that has already happened. It's not telling you anything about the probability of what is happening and what is going to happen. And the whole point of trading is to be in a position to be able to know the probability of what is happening and what is going to happen so that you can make the correct trade, the winning trade. Right? Now you can say to me, well, before there was VEPS, people still traded and people were successful at it. So what did they use then? Right. Markets change. Times change. History changes. Human civilization changes. And also fortunes change. And people that were using traditional TA or other forms of technical analysis before the VEPS and before the whole thing that created the VEPS originally, which was decades ago, the Black-Scholes model, what people were using, well, a lot of it was based on luck, and a lot of them had either good luck or bad luck, and that would basically determine whether or not you would be a successful trader or not. So don't leave your trader. That's just not worth it. VEPs, trade the VEPs, bank on the VEPs. That's the way to go. But that's it. So you guys happy trading.